Hey guys, I hope you all are staying safe and you all are following the social distancing measures. It's crazy times and we really don't know how long this is going to last. But the important thing is for us to stay at home and make the most out of this time. So, what I have decided to do is I have decided to pull out my old toy box. Many years back, I used to be very active in the options market. Now, I'm not a I'm not an options trader. I never try to predict the markets, but I absolutely love using options in a very creative way, which is aligned with our long term investing. And I'm going to show you some of the strategies which are very close to my heart. I absolutely love using them. So let me share the screen and let me demonstrate a very interesting strategy which can come very handy in volatile times like these. Now, what you see on the screen is the implied volatility chart of Berkshire Hathaway. Now, uh, if you look at the implied volatility chart of any company, it would look something similar like this. The IVs are very elevated across the board, and just see how this is kind of, you know, very unprecedented. In the last 4 years, Berkshire has never had its implied volatility rise so high. So, how do we take advantage of this elevated implied volatility? Now, by the way, this is not a recommendation. While uh, I like Berkshire Hathaway, I am a very ardent follower of Warren Buffett, but by no means I'm trying to recommend you purchasing this stock, or I'm not trying to recommend you do this option trade. I'm just showing you how you can take advantage of the elevated implied volatilities in positioning yourself in certain way. Now, if I look at the option chain of Berkshire Hathaway, we see that uh, Berkshire has leap options. The farthest expiry is June 17th, 2022, which is over 2 years from now. So now it's April. So 2 years and 3 months. So we are going to take those options and we are going to use them. Now, see, the thing is, if I look at the Berkshire share price, uh, Berkshire Hathaway has a book value of about $175. And we know that Warren Buffett is sitting on, at least he was sitting on, as of the end of last quarter, of around $129 billion of cash. And there's another fact that we know that he has been buying back stock even at the levels of 220. That is, I'm talking of the Berkshire B shares, because that is what we are going to use for this option strip. Now, uh, he spent about $5 billion buying back stock, and that was, somewhere around 220 levels, because during the whole quarter, that is where the share price was. So right now, Berkshire is trading at $178. So that is marginally above the book value. So that itself is very attractive if I want to buy the stock. However, if I want to buy, even if I want to buy 100 shares of Berkshire Hathaway, the B class shares, that will cost me about close to $18,000. And I do not want to uh, deploy so much of capital. I want to keep my powder dry, because I feel there could be many other interesting opportunities coming our way. And more importantly, I actually don't have too much of spare cash. I'm fairly invested, so I'm using some interesting option strategies to generate more and more cash as we go forward, and I'm going to share with you some of those strategies. Now, I was thinking that what if I buy a long term call, which is a leap call, uh, 220 strike expiring in June 2022. So, that opens up the upside for me. But the only problem is buying one contract of that call will cost me $1,720 if I'm just going by the ask price. Of course, in reality, I can get it slightly cheaper. But you know what? I don't like paying from my pockets to buy options. I never do that. So let's look for other alternatives. And moreover, when the implied volatility is so much elevated, buying an option directly outright may not be the smartest thing to do, because when I'm buying an option, I'm also exposing myself to a drop in implied volatility. So what if I go and sell an option, and instead of buying the call, what if I sell a contract of 170 strike put? So effectively, this will position me to buy Berkshire Hathaway if it comes down to 170, if it trades below 170 at the time of expiry, which is like 2 years away. Now I get a very juicy premium, just one contract. Even if I sell it at the bid, in reality I can sell it at a slightly higher price. I always uh, put in a limit price which is between the bid and the ask. But even if I sell it at the bid, I bring in $2,490 of credit. Now, that beautifully positions me to buy Berkshire Hathaway, 100 shares of Berkshire Hathaway at $170. And my uh, effectively, because of the credit that I bring in through the option premium, my break even becomes $145, which is ridiculously low. However, there is a problem in doing this. That is, yeah, while I managed to uh, position myself to buy Berkshire at 170, but what if Berkshire does not trade below 170 as of the expiry of my option? Which means I'm missing a golden opportunity to buy Berkshire Hathaway at the current depressed price. And if Berkshire, if let's say the virus situation plays out, and after that, if Berkshire goes up significantly, I'm missing that upside. So I'm not happy with that either. So what I'm thinking of doing is, what if I do a combination of the two? What if I position myself to have a payoff diagram like this, where you can see that this vertical line, this is the zero line, and on the right of this, on the x-axis, it shows the profits, the payoffs, and on the left, it shows the loss. Now, by doing a combination of buying that long call and selling that put, I can position myself to bring in a credit of $3,760. Now, what I'm doing is I'm buying that long call, which is a 220 strike call, but I'm funding that instead of paying from my pocket. I'm funding that by selling two contracts of 170 puts. Now, I could have sold just one contract. That way, the credit would have been much less. So, by doing this, I get a payoff diagram like this. Now, here, my break even is about $151. So anything above $151, on the y-axis, we have the stock price. So anything above $151, I'm at a profit zone. So which means if Berkshire sits between $151 and 170, sorry, $151 and $220, so I make a profit, and around between 170 and 220, my profit is the credit which I bring in, which is 3,760. However, if Berkshire rallies from here, then above 220, I have a beautiful upside. And you know the best part about this, doing it this way? Now, remember, if I I bought just 100 shares of Berkshire, that would have given me a delta of 100. Now, if I just Now, if I just, oh, I need to bring it down so it doesn't come in the way. Now, if I just bought the long calls, while I would have enjoyed the upside if Berkshire really rallied, but around the current levels, my delta is just below 36, which means for every dollar move in Berkshire, this uh, position is going to give me a, a benefit of about $36. And that, of course, will keep increasing because there is something called the gamma, which will help that. But if I look at my combination trade, I'm getting a delta of 105, which is equivalent to buying 105 shares of Berkshire. So for every dollar up move of the Berkshire stock, my position will benefit by $105. And to do this, I'm actually bringing in a credit of 3,760. And this credit I'm getting upfront, which I'm free to use this to invest in any other stock at this price or invest in whatever way I want. So, this is an absolute beauty of a payoff diagram, which positions me to acquire Berkshire shares. That is, I will get assigned the shares if Berkshire trades below 170, which is at this point. If Berkshire trades above 220, now remember, I have the 220 calls, so I will have the right to acquire the Berkshire shares at 220. So even if after these 2 years, it's actually 805 days. Even if Berkshire is around 250, I still have the right to acquire Berkshire shares at 220. So below 170, it's an obligation. Above 220, it's a right. And anything between 170 and 220, while I don't get the shares, but I still sit on a profit, which is the credit which I have brought in. And I actually have the option of using this money to invest in Berkshire shares, if not anything else. And, that will still give me an upside. So, there are many such very creative ways of using options. And we are coming out with our option series subscription program very soon, where we will be demonstrating several very interesting strategies where you can be very creative with options. And as you can see, there is no chart analysis involved. I'm not trying to make any kind of prediction where the Berkshire stock is going to be. I'm just saying that if it's below 170, that's great for me. I will be acquiring Berkshire Hathaway at a price which is way below what Buffett himself is acquiring the shares for. If it's between 170 and 220, I will enjoy my credit. And if it's above 20, I get to enjoy my upside. So this is an absolute rock star of a payoff diagram, which we have established here. So I invite you to pre-register for the course by going to moneywisesmart.com/options. Unfortunately, the seats will be limited because we would like to restrict the number of registrations for the very simple reason that we like to provide personalized support to our students. And it becomes very difficult if there are a large number of students in each batch. So we will have to restrict each batch. So I encourage you to pre-register by entering your name and email address here, and you will soon get to know when we launch. I think realistically, we should be ready to launch by the end of this month. And I will keep releasing several interesting videos showing you interesting ways of using options. So I'll see you soon in the next video. Thank you very much for your time.